Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 2nd of March 2020, and yesterday we published the most important video entitled Why Gold and Silver Prices Fell on Friday. And on Saturday we published our Gold and Silver Weekly Update for the week ending the 28th of February. And we've placed links to both of these in the description box below. Amongst these two podcast videos, we gave explanations why gold fell 3.5% and silver fell 9.8% last week, and what we should expect moving forward, especially with this week reporting a considerable amount of US economic data. Now, before we look at what has been happening today, we thought we should alert you to our Richard and Greg channel, where Greg, interviewed by Journo Marcus this morning, has given his update on where we are with COVID-19. And the two of them discuss the ramifications this is having on public gatherings, sports, and children's education, not to mention any financial consequences. Now, we've placed a link to this video in the description box below as well. Okay, at the time of producing this, it's 17:30 GMT, and Wall Street has been open just a couple of hours. We are witnessing US equity markets up on average 2.5%, with the Dow back over 26,000 at 26,076. European markets are broadly up, but by a much smaller percentage, and similarly Asia Pacific markets. Crude prices are some $2 higher, and the dollar index is down 0.8 at 97.2. Gold is currently up $9, and in sterling terms £8, and silver is currently up 10 cents, and in sterling terms 9 pence. Therefore, at this precise moment, the gold to silver ratio is 95.2. Now, just a reminder for those who haven't listened to our previous videos, the reason for such a high gold to silver ratio, and a diverging one, can be condensed into 2 points. One, gold is seen as the truest monetary metal, and in times of uncertainty would be where professional investors would flock, and silver, being seen as a partial monetary metal, would benefit also, but would at the same time be held back by any decline in industrial demand, which a global recession would cause. And so even though its price could rise, it would generally be subservient to the gold price, at least short term. This is why we've seen the divergence in the gold to silver ratio, which just over the past month, we've seen it move from below 85 to 1 to above 95 to 1, and over the past 3 years from 68 to 1 to its current level. And since yesterday's video, we've seen this divergence expand further, albeit by just 0.1. Now, interestingly, we stated yesterday that when markets open, there would be a possibility of a further $20 decline in gold and 25-cent decline in silver prices. But as to whether this would hold or not would be determined by data and whether the Fed lowers rates or not, or the expectations of it lowering rates. Interestingly, after the first 5 minutes of opening, gold did actually fall to $15.75, down $11, not 20, but down 11. And silver fell to $16.45, 23 cents, not 25, but 23 cents, but have obviously recovered quite quickly. Now, we have to say that even while writing this video podcast, the silver price is oscillating between being in negative territory, because when we first started this, it actually was down a couple cents, and it's oscillating between negative territory and positive territory. Clearly, this is a most volatile market at present, especially as silver did actually touch $17.05 at one point. So there are oscillations within about a 60-cent bracket. Now, this morning, we've had the market manufacturing PMI reported for February, which came in at 50.7%, just 0.1% lower than January, And the ISM Manufacturing Index reported 50.1% for February, 0.8% lower than January, but 0.4% lower than market expectations. Construction spending for January was up 1.8%, some 1.6% higher than December, and 0.9% higher than expectations. So a little bit of mixed news there. Now for an important announcement which we feel everyone should be aware of. You may remember that we mentioned in our weekly update on Saturday, and repeated this again in our video yesterday, that the Fed may adopt a surprise rate cut over the weekend or early into this week. Well, we can enlarge on this today by stating that there is a high probability, not certainty, but high probability, that all of the major central banks will cut rates on Wednesday or Thursday of this week. Now, the Fed funds market has already priced in a 0.50 basis point cut for the FOMC meeting due on the 18th of March, or at least that's according to the CME Fed Watch tool. It's our estimate that the Fed may actually reduce rates this week by 0.25% and see the market reaction before committing to an even lower rate later in the month if it does so. Now, this is where the situation becomes somewhat tricky. One would expect gold and silver prices to rise if the Fed does actually cut rates. However, if all central banks cut their rates together and at similar percentages, then the US dollar is likely to maintain its current relative value. In addition, we will then quite possibly see equity markets rise further, and monies could flow back into them once again. Having said that, on a positive note for precious metals, those individuals who sold gold last week to make margin calls, if equity markets do go up, may no longer have to sell any additional gold this week. And this could provide a solid foundation for the gold price, or certainly prevent it from falling further. Now, we wish we could be quite so positive for silver, but if the Fed and other central banks do cut rates this week, then frankly it will send the message to the marketplace that global trade is in trouble, and this will have an adverse impact on industrial metals. The question one then has to ask is, will the upward pressure on silver demand as a monetary metal be greater than the downward pressure on it due to a lowering demand for it as an industrial metal? And this calculation is one of the most difficult to make. Unless, of course, we're in the midst of a global panic, and then, of course, the answer is quite simple. We know for certain that as we produce this podcast, central bankers are discussing whether to lower rates this week or not. What we do not know at present, and quite likely will not know in advance, is their ultimate decision until it is announced. Our best estimate at this time is that they will. But if they do, then we can expect, despite the caveats I've already given, we can expect gold to rise even though the dollar may maintain parity. Now, by how much, we haven't done the calculations, as this news is recent. But there is no doubt that it will act as a tailwind behind precious metals, which is why, certainly for gold, we are buying on dips right now. Not significant amounts, because as we have seen, there is a substitution effect for equities too. And of course, we must not forget that if all of the central banks lower rates, then proportionately the US dollar still remains attractive compared with most other countries' currencies. And it does certainly appear, as evidenced on Friday, that the first port of call when coming out of equities is to initially go into the dollar, with small amounts going into precious metals. And of course now, if equities become more attractive, then those additional monies will not be going into precious metals to the degree that we would all wish to see. On that note, we shall provide a further update tomorrow, and please bear in mind the links that I've already referred to, and please by all means express your comments below, and if you haven't already done so, kindly subscribe to our channel, not forgetting to press the bell sign so that you are notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.